Hey everyone, welcome back to Corporate Decoder, the place where we decode SEC filings and see if companies are truly swimming or just treading water. Today we're diving into a report from Nuwellis Inc. and let's just say they've been busy making some pretty significant decisions. This is a current report that companies file when something important happens, something that shareholders need to know about right away. Think of it as a company's way of saying, hey, pay attention, this just happened. So on August 4th of last year, Nuwellis held a special meeting with its shareholders and it was done online. This means people could join from anywhere to hear what the company had to say and vote on some key issues. Now, what were these key issues? It looks like they wanted to get the go-ahead from their shareholders to do something pretty big. One of the main things they wanted approval for was to increase the number of shares of common stock they're allowed to issue. They wanted to go from a maximum of 100 million shares all the way up to 200 million shares. But that's not all. They also asked for permission to do a reverse stock split. Now, a reverse split is when a company reduces the number of its outstanding shares, often to boost the share price. They gave themselves a lot of flexibility here, saying they could do it at a ratio anywhere from 1 for 5 shares all the way up to 1 for 70 shares. The reason they gave for this is pretty important. They need to do it to meet the requirements to stay listed on the Nasdaq stock market. They also said the board would decide if and when to do this within a year of the shareholder vote. To get these things approved, they needed a majority of the votes cast. This is pretty standard for these kinds of shareholder meetings. Now let's look at how many people actually showed up to vote. About 130,000 shares were represented, which is a little over 45% of all the shares. This means a good chunk of the shareholders participated, which is always a good sign. Let's break down the voting results for each proposal. First up, Proposal 1. This was about approving the issuance of shares related to warrants from a financing deal that happened back in June 2025. This is basically a nod to allow more shares to be issued because of a previous financial deal. For Proposal 1, the shareholders voted overwhelmingly to approve it. We saw roughly 28,000 votes in favour and only about 6,600 against. That's a pretty clear win for the company on this one. Next, Proposal 2, which was to increase the total number of authorised shares from 100 million to 200 million. This gives the company a lot more room to issue new stock in the future, maybe for funding or other strategic moves. This proposal also passed with a strong majority. More than 42,000 votes were for it, against about 15,700. This shows shareholders are comfortable with the company having more flexibility in its share structure. Then we come to Proposal 3, the reverse stock split. This is usually a move made when a company's stock price has fallen quite low and they want to bring it back up to meet exchange listing rules or just to look more attractive to investors. The fact that they need to do this to stay on Nasdaq is a pretty significant signal. Here again, shareholders gave their approval. Over 41,000 votes were in favour with about 17,000 against. It's clear that the shareholders understand the need to comply with Nasdaq's rules, even if it means a reverse split. Finally, Proposal 4 was to give the company the option to postpone the meeting if they didn't get enough votes on the earlier proposals. This proposal also passed with a vote of about 41,800 for and 14,600 against. It seems the shareholders trusted the company's leadership to manage the process if needed. So what's the story here on the surface? Nuwellis got all the shareholder approvals it needed to increase its authorised shares and to authorise a reverse stock split to stay on Nasdaq. The shareholder turnout was decent and the votes were largely in favour of the company's proposals. However, let's dig a bit deeper. A reverse stock split is often a sign of a company that's been struggling with its stock price. It's a way to artificially boost the price per share, but it doesn't change the underlying value of the company. If Nuwellis is facing delisting from Nasdaq, it suggests they haven't been meeting the ongoing minimum bid price requirements, which is typically 1.00 per share. This often happens when a company's market value has declined significantly, or its stock performance has been weak. The need to authorise a reverse split of up to 1 for 70 is quite a drastic measure. This implies their stock price may have fallen very low, potentially to just a few cents per share. A 1 for 70 split would mean for every 70 shares an investor owns, they would end up with just one share, but with a price that is 70 times higher. While this may keep them in compliance with Nasdaq's minimum bid price rule, it doesn't solve any underlying business problems. Increasing authorised shares to 200 million from 100 million as approved gives them a lot of firepower for future capital raises or potential acquisitions. However, without a clear strategy to leverage these new shares effectively, it can also lead to significant dilution for existing shareholders if new shares are issued too cheaply. The approval of the issuance of shares related to warrants from a June 2025 financing transaction also indicates they are actively managing their capital structure through such agreements. Looking at this broadly, Nuwellis seems to be in a phase of trying to stabilize its position, particularly with Nasdaq. The approvals are a necessary step for them to continue trading on a major exchange, which is crucial for liquidity and investor access. However, the core issue remains the company's underlying financial performance and its ability to generate value that translates into a healthy stock price without these artificial adjustments. The company's direction appears to be focused on survival and maintaining its listing. The risks are clear. If the business doesn't improve, even a reverse split might only be a temporary fix. The opportunity lies in whether the company can leverage this breathing room to improve its operations and financial results. Without seeing the actual financial statements in this filing, it's hard to judge the long-term prospects, but the need for a significant reverse split is a red flag many investors watch closely. Now, what's your take on these moves? If you're a Nuwellis shareholder, how do you feel about the reverse split and the increase in authorized shares? Let us know in the comments below. If you found this breakdown helpful, please hit that like button and subscribe for more decoding of corporate filings. And don't forget to join our Discord community linked in the description for more discussions. Thanks for watching, and we'll see you in the next one.